Hey Rich Girls, Kirby here, and welcome to another episode of Rich Girls Guide. One of the hottest topics over the past several years that just keeps popping back up: first-time homebuyers. Now, we've all seen the articles and talked with friends. People paying $20,000 over asking price, multiple offers on mediocre homes within 24 hours of it hitting the market, millennials not being able to afford homes, and worst of all, dare I say it, waiving home inspections. We are discussing it all today. Everything you need to know as a first-time homebuyer. Interest rates, down payments, when to buy, how much can you afford, and most importantly, where do you start? Stick around to the end to hear my favorite home buying hacks and which ones I would avoid. Before we dive in, I have a quick message for you today. One of my goals for 2024 is to focus on growing my YouTube subscriber count. And in the spirit of being fully transparent, I am trying to hit 1,000 subscribers. If you enjoy this content and if you want to help support me, please consider hopping onto YouTube right now and hitting that subscribe button. I appreciate each and every one of you listening more than you know. Please note, this is not financial advice. This is simply my opinion and should be used for entertainment purposes only. Real quick shout out to Anna, my sister-in-law. She got me a Secret Santa and got me the cutest little custom cup. Love it. Let's start with the basics. Where do you start when you're thinking about buying a home? I think I can speak for a lot of millennials when I say there are going to be a lot of talking heads in your life trying to give you advice, information, and opinions when it comes to you buying a home. While this mostly comes from a place of good intention, family members wanting to help or coworkers wanting you to avoid the mistakes that they made, be aware that there will also be people with less than the best intentions. Regardless, it all amounts to little more than noise. While you should certainly ask around and crowdsource some information, I would pick out one or two main sources that you rely on for your information. A trusted contact that is seasoned in the world of home buying or a realtor that you trust can be great sources of information. Talking heads, like me, don't know your exact situation. So while I can help you get started in the right direction, having a trusted contact or realtor that knows you, is savvy in the world of real estate, knows the area you are looking in, and most importantly, has contacts can be extremely beneficial throughout the home buying process. And don't worry, I will get to the pros and cons of buying with or without a realtor later in the episode. Let's go over the timeline of buying a house. First, we are going to figure out exactly how much we can spend on a house so that we are not wasting our time and energy looking at homes out of our price range. If you follow along with the rest of today's episode, you can figure out that figure in just under an hour. Next, you are going to want to reach out to a realtor and a lender. Now, a realtor is the person who will take you through the homes, walk you through the entire home buying process, start to finish, communicate with the sellers on your behalf and advocate for you, and essentially hold your hand until you have keys in your hand. The lender is the person who is helping you get a loan, aka the mortgage, on your home. I would interview or talk with a few different realtors and lenders. That might take you a week or so to nail down. Once you have a lender, you will need to get pre-approval for a loan. This is not the same as getting approved for a loan. This is essentially just a piece of paper saying you will most likely be approved for a loan up to a certain dollar amount. And it will allow you to walk through homes and figure out how much the bank is willing to lend you for a mortgage. Getting a pre-approval letter is usually pretty quick. The lender will just need some basic information from you. If you have all your ducks in a row, think prior pay stubs, income amounts, and you can get them the information quickly, you should have your pre-approval letter in a week or less. Now, once you have your pre-approval letter, you are able to go on the hunt and actually tour homes. Timing will obviously depend greatly on the housing market and your individual needs. If you find your dream home the day you receive your pre-approval letter, you could receive an accepted offer within 24 hours. You should also probably go get a lottery ticket because that does not happen. If the market sucks and there is nothing available, or maybe you're just not in a rush, this can drag out for months or even years potentially. The important thing to remember, there is no reason to rush into buying a home. This will most likely be the single biggest purchase you will ever make in your life. And I would so much rather you have a few weeks or months of FOMO from not putting in an offer on a house than years of buyer's remorse due to rushing into a bad purchase. Now, once you have an accepted offer, you and the seller will most likely choose a tentative closing date that is anywhere between 30 to 45 days out from the date that the seller accepted your offer. Sometimes the sellers will want to rush things, although anything shorter than 30 days is really hard to pull off on the lender's side. Other times you may need to push out closing due to unforeseen circumstances, and closing can sprawl out over 60 days even. Once that tentative closing date is set, the clock starts ticking. There are certain things that need to be done, such as a home inspection and forms that need to be signed within a certain time period in order for you to reach that closing date on time. This is where having a realtor can be worth every penny. The absolute first thing you are going to want to do, even before you start scrolling through Zillow or reaching out to realtors, you need to nail down exactly how much you can afford to spend and how much you are willing to spend. This applies to 3 areas: your down payment, your monthly mortgage, and the total home purchase amount. I strongly encourage you to go through the numbers before reaching out to a realtor or a lender. Calculate your numbers first, because the lender is going to come up with very different numbers. The lender is essentially calculating the maximum amount that you can afford according to your income, not what feasibly fits into your budget. The lender is only looking at your income, your assets, and any outstanding debt. They do not care if you spend $2,000 a month on daycare or that you are putting away $1,000 into your savings every month. They are strictly looking at the money coming in and required debt payments going out. So the onus is on you to figure out how much you can and how much you want to spend on your mortgage month to month. Another thing to think about is how much of a total home price you are willing to pay for in your area. Just as a quick rule of thumb, I typically try to make sure our total monthly mortgage is below 25% of our take-home income, which includes principal and interest and escrow. Plus, I like to add in any homeowners association fees if applicable. Really quick, for those who don't know, principal and interest is something you are paying to the bank, aka the lender, who gave you the loan. You are paying back part of the loan amount, which is the principal, and you are paying them interest, essentially their payment for loaning you the money. Escrow is just a fancy word that means your homeowner's insurance and your property tax. Escrow is collected by your lender, and they disperse those funds to your homeowner insurance company to pay for your homeowner's insurance and to your city or county to pay for your property taxes. Now, going back to take-home income. Take-home income for me is what hits our bank account on a monthly basis after taxes, health insurance, 401k contributions, and HSA contributions have been taken out. Now, depending on your expenses, you may want to increase or decrease that percentage accordingly. Again, we use 25%. Once you have a solid dollar amount you are comfortable with spending month to month, let's say that number is $2,000 a month, now we can back into how much house you can afford. We will need to Google average home interest rates to get a rough idea of what your interest rate might be. For today's episode, we are going to use 6%, which might be off, but we are just going to use it for illustrative purposes. Now, I am going to show you my screen with my handy-dandy homemade mortgage calculator and show you how you can mess around with the figures to back into how much of a loan you can afford based on that monthly figure we just came up with. Okay, so here we have the home purchase amount, the down payment, which I pre-calculated as 20% of whatever the home purchase amount is, our annual interest rate, term of the loan, aka number of years our mortgage will be paid off, total number of payments, which will impact how much interest we'll pay over the life of the loan, payment per period. This is just the principal and interest based off of the figures above. Total sum of principal and interest payments just for shits and giggles, and total amount of interest paid over the life of the loan. That's just for shits, no giggling over here. Now, before you make the mistake of looking at payment per period and thinking to yourself, yay, we are well below our $2,000 limit, let's move forward with finding a $350,000 home. No, wrong. We still need to add in escrow, insurance, and property tax. While P&I, principal and interest, will not deviate throughout the life of your loan, escrow will fluctuate year to year. Homeowners insurance will go up and down, mostly up, due to factors such as the age of your home and just the overall economy. Property tax will also go up and down, again, mostly up, in conjunction with the value of your home. Your locality will go around every year or two and update your property value. It's honestly kind of bullshit. They usually just send a person to look at your home from the street and they assign your home an assessed value. But the good news is that these assessed values are typically lower than the market value of your home. Typically. I would Google what the property tax percentage is for your specific area. I'm going to use 1% in this example because that is pretty average for the counties around me. Homeowners insurance is another thing you can Google. I would just type in the total home price you are looking at, in this case $350,000, and average annual homeowners insurance cost. Now once you have that figure, you can type in this formula in Excel or just add the two annual amounts for homeowners insurance and property tax, and then be sure to divide by 12 to get your monthly amount. So now we can see that instead of having well below a $2,000 monthly cost, we are actually over our housing budget by almost $200. So let's mess with some numbers. Instead of purchasing a home worth $350,000, let's decrease that amount to $300,000. That brings our 20% down payment down from $70,000 to $60,000. Now, let's say you actually don't have $60,000 saved to put down on the home. You only have $50,000. We can override the formula and type that in right here. Just a reminder, you don't actually need a full 20% to put as a down payment on your home. We can now see that the loan amount changes to $250,000, the difference between the home price and your down payment. Now, because we are putting down less than 20%, even though it is allowed, we will need to add in PMI, private mortgage insurance. This is required by the lender in cases where you are putting down less than 20% of the home price value, and the dollar amount you will have to pay will depend upon how much you are putting down, the home price, and your credit score. Think of it as the lender getting additional insurance to protect them in the case that you default on your loan. I'll put a link down below. NerdWallet has a great PMI calculator that you can use, and in this example, they gave me an estimated PMI of $165 per month, which seems right on par. Two things to note about PMI. You will not need to pay this for the entirety of your loan. You will only need to pay this until you reach 20% equity in your home. However, most lenders will not automatically calculate you reaching 20% equity. You will need to proactively reach out to the lender once you hit 20% equity and ask them to remove the PMI. Sometimes they will require this in writing. Just be sure to find out their specific requirements because it will vary lender to lender. Moving it on down, your interest rate will stay the same no matter how much you are putting down. The only things that will really change your interest rate is if you shorten the term of your loan, aka decrease the years from 30 to say 20 or 15. Typically that will lower your interest rate. If your credit score changes, that can also impact the interest rate. But the most important factor is just the overall market. That is really going to dictate interest rates. So just keep that in mind. Rates will fluctuate month to month and even week to week, just depending on things that could be outside of your control. So with all of that being said, we are still over our $2,000 budget by almost $150. Now, some people will see that and say, hey, we can cut something else out of our budget until we hit the 20% equity in our home. I'm not worried about it. Others will look at that and say, we are already cutting it close to being able to afford the $2,000 a month. So let's cool on the home search until we can save up more for a down payment or wait until interest rates drop a bit. I think both of those can be a mature decision. Obviously, there are going to be outside factors that are playing a role in your decision, such as rental prices going up in your area, leases coming to an end, wanting a yard for the furry family members, or extra room for the kiddos. As long as you can work this into your budget feasibly, and you are not stretching yourself too thin, I think you can argue either decision. Now, before we get too excited, there are a couple of other costs you may incur during the home buying process. Home inspection, realtor fees, and closing costs. The buyer will pay for the home inspection, typically out of pocket. Luckily, you do get to choose your home inspector, and you are able to be at the home during the inspection. I would highly recommend getting a well-known, reputable, seasoned home inspector. They are well worth the money, and in my experience, they typically cost around $500 to $600. Obviously, that will fluctuate based on your location and potentially the size of your home. Depending on what they find, the seller may have to pay for certain repairs, or if the inspection comes back and there are some alarming findings, think foundation is, you need a new roof, all the windows need to be replaced. If there are really big surprises that you were not anticipating and that the sellers did not disclose, and for whatever reason the seller is refusing to pay for those repairs, you can typically back out within a certain time period and walk away from the home purchase scot-free. Sometimes you will need to pay an earnest money deposit once your offer is approved. This can be anywhere from $1,000 to $3,000 that you, the buyer, give to the seller. Now, as long as you go through with the home purchase, that money will be applied to your loan. Think of it as a deposit on a reservation at a super fancy restaurant. If you pay $50 to get the reservation, that $50 will be applied to your final bill. But if you miss your reservation, the restaurant is keeping your $50 as essentially a cancellation fee. Same thing for an earnest money deposit. As long as the sale goes through, that money is applied to your purchase. However, if you get cold feet and it is not because of something covered in the contract that you signed, you are forking over that $1,000 to $3,000 to the seller as a sorry for wasting your time. Most contracts will have a caveat, something called a contingency, that within a certain number of days after the home inspection report is provided, typically like a week, if you as the buyer are not satisfied with the condition of the home, you can walk away and still receive your earnest money deposit back. This is just one of the many reasons why I push for first-time home buyers to have a realtor. They will know your contract inside and out and help you navigate this process while it is unfolding. As a home buyer, during a normal housing market, you can typically ask for the seller to cover both the realtor fees and the closing costs, up to a certain percentage, anywhere from 3 to 9% of the home price. Now, this will vary depending on the market your location, the type of loan that you are getting, and most importantly, the seller. If they don't want to cover any fees, they are not obligated to. I would highly recommend discussing with your realtor whether or not it would be in your best interest to request certain fees be covered by the seller in your offer. When the market gets crazy, or if you are buying in a really desirable location, that is when you may need to sweeten up your offer by covering closing costs yourself or covering part of the realtor fees. Typically, the realtor on each side will require 2.5% to 3% of the total sales price as their commission. So the total realtor fee will typically range from 5 to 6%. So in the case of a $300,000 home, the realtor fee could be anywhere from $15,000 to $18,000. Now, closing costs will also vary depending on the home price, and this will include a whole slew of things such as credit report fees, application fees, attorney fees, closing fees, you name it, there's a fee for it. These are things you are paying the lender to do in order to finalize your loan, and typically you cannot negotiate these. They will total at least a few grand, and this is something you can ask your lender about when you initially interview them. I would definitely recommend reaching out to a few different lenders depending on your patience and schedule. I would call at least 5 different places if you can, and make sure to ask them all of the same questions. Now, if I were buying a home today, these are the questions I would ask. What is the best interest rate you can get me? What will you charge in closing costs on a $300,000 home? And how available are you to talk with me throughout the home buying process? Of course, they will need some information from you before they can give you exact figures, but they can at least get you some ballpark numbers, and you will get a feel for which lenders you vibe with, and importantly, who is giving out the best interest rates. I would also be diligent about reaching out to different kinds of lenders. National bank lenders, think those big bank names, local or regional lenders, and if your realtor has anyone that they love to work with, I would give them a call too. Should you get a realtor or try to bootstrap it yourself? Now, I have bought homes with a realtor. We bought one home without a realtor. We sold a home without a realtor and sold a home with a realtor. I know, mental gymnastics over here. And when I say I mostly mean my husband. From our experience, using a realtor is typically going to save you time, sanity, and most importantly, money. Unless you work in real estate or you have all the time in the world to spend on this endeavor, it is most likely going to be in your best interest to work with a realtor. I know it sucks to see those huge commission amounts and to be tempted to just do it yourself. And for some people, they can do it themselves. We got extremely lucky and we were able to scrape by when we did do it ourselves. But more likely than not, a realtor is going to be worth the price tag. They will negotiate for you, make sure you are signing everything on time, and keeping up with the 1,000,001 tasks that have to be done. And honestly, the headache that they endure on your behalf is worth so much money, in my opinion. Just make sure to do your due diligence when interviewing realtors. You want to get a seasoned professional who knows your area and is willing to advocate for you. A hot question that always seems to be swimming around: when is a good time to buy? Well, if you are clairvoyant and you can predict when the housing market will be down, then it's easy. Buy when the market is low and sell when the market is high. For the rest of us schlumps who can't predict the future, the answer gets a bit more murky. Personally, I think that as long as the market is not crazy overpriced, you have the appropriate funds available to put down between 10 to 20% as a down payment, and you can easily pay the monthly mortgage, there is really no reason not to buy a home. A few caveats here, of course. If you are anticipating staying in the home for less than 2 years, I would not purchase. If you do not like the area you are in and you are actively looking to move within the next few years, I would not purchase. Or if you can feasibly afford the down payment and your mortgage, but you do not have the extra income to pay for home repair and maintenance, because you will have to pay for home repair and maintenance, Appliances will die. Floods will happen in the basement. Roof tiles, they fly off in storms. There is so much more than you could possibly think of. And if you cannot pay for random fixes throughout the year, I would maybe cool the brakes on home buying just right this second. If you do fall into one of those categories, I would really focus on saving more money in your emergency fund, putting more aside for a down payment. And if you are really serious about buying a home sooner rather than later, maybe start a savings fund that is specifically for home repair and maintenance. Home buying hacks I can get behind. Buying a duplex or multifamily home and renting out one or more of those sides. You are building equity more quickly, and you can potentially decrease your portion of the mortgage bill. Depending on how well you could do it, you could live there rent-free. This is something I have personally done. We bought a duplex, and it was by far the single biggest boost to our net worth when we were in our 20s. 2, paying down principal. If you have a high interest rate or your mortgage is your only debt, it can be to your advantage to pay more towards your principal, especially in the beginning of your mortgage journey. The more principal you pay off, the less interest you will pay over the life of the loan. This is true even if you don't plan on living in the home over the full term of the loan, which is most likely 30 years. You will reap those lower interest payments immediately after paying more towards principal. Just be careful. When making a payment to the lender, you want to make it abundantly clear that any extra payment you are making is towards principal. Bonus points if you have receipts. Remember, your lender is a business, and if they can get away with putting that money towards interest or future monthly payments, they will. I know from firsthand experience. Write it on the check, do it online, however you need to do it, just get those receipts. Third, getting a non-traditional mortgage term. AKA, instead of a 30-year mortgage, you opt for a 20-year or a 15-year mortgage. If you can swing it, this is an amazing hack. You will build equity more quickly. You are most likely getting a better interest rate from the lender, and you are more than likely buying below your means. I would smash. Home buying hacks I would avoid. Paying off all or part of your mortgage with a HELOC or other loan, and then trying to pay off that new loan quickly. This is just a whole other level of headache, and honestly, it is incredibly convoluted. There are very few instances in general that it makes sense to pay off one loan with a different loan, and this is not one of them. If you want to pay off your mortgage more quickly, make sure you are buying below your means and you are putting extra payments towards principal. This is the easiest way to pay off your mortgage quickly, and it is building and reinforcing healthy financial habits instead of trying to skirt the system. Second, paying homeowners insurance and property taxes yourself instead of giving it to the mortgage company. Some people who may or may not have too much time on their hands, have figured out that instead of sending escrow, property tax, and insurance to the mortgage company, they can pay those directly to the entities themselves. Since property taxes only have to be paid twice a year, the idea is that you put money away every month in your own high-yield savings account, reap the interest on that money, and then twice a year, you pay your property tax bill. If you really want to go through that headache to get maybe $100 a year in interest, go for it. The time, effort, and potential for me to forget and just not pay the bill is not even close to worth it for me. I would much rather spend the couple of hours that would take to set everything up by just picking up an extra photography gig and making so much more than I would in interest in one photo session. All right, before we wrap up, I want to go over a few red flags and green flags I have encountered and or seen during the home buying process. Red flags. The seller is pushing you to buy without a realtor because they will drop the price of the home for you. The seller is pushing you to put in an offer without a home inspection. Your lender is trying to sell you on a higher loan amount than you can budget for. Your realtor is pushing you to make an offer on a house not because you love it, but because there are other potential buyers also putting in offers. Whenever things get too hot in the market and people are pushing you to make quick decisions that are outside of your comfort zone, it might be a sign to take a step back and reevaluate. Buying a home should not be an impulse purchase. Green flags. Your lender is walking you through your options and taking the time to explain your options and answer your questions. Your trusted realtor is advising you against a home because something just feels off to them. The seller agrees to your concessions, such as paying to fix windows that were flagged during the home inspection. Please, for the love of God, if you get nothing else out of this episode, please do not buy a home without getting a home inspection. Hopefully that was a pandemic trend that is dying out, but I have heard of so many first-time home buyers in the past couple of years that waived a home inspection, put in an offer over asking, only to have like 10 other more attractive offers put in on the same day. It's giving desperate. It's giving, you're gonna regret this in a few years. Whenever you start to see red and you just want to jump in because you don't want to be left behind, that should be a sign to take a step back, take a few deep breaths, and do some critical thinking. Now, to be very clear, I am not throwing any shade. If you are one of those people who paid above asking or waived a home inspection, you are one of literally thousands of people. And for some of you, it may have worked out. For others, however, you may not be able to sell your home for as much as you paid, or you may need to fork over some serious money to have work done on the house that you were not anticipating. Home buying is not a simple process, so the more knowledge you have, the better equipped you will be. Don't be afraid to ask questions. Don't let sellers or realtors trample over you just because of your age or because this is your first time buying a home. Take your time, do your due diligence, and most importantly, try to have fun. There was a lot that I did not get to cover in this episode because this has been pretty long already. If you want to know my thoughts on the pros and cons between home ownership and renting, what exactly a refinance is and when it makes sense to do a refinance, how to calculate how much equity you have in your home and how much you'll have in 5 years, or how much longer it would take to pay off your mortgage if you're putting extra money towards principal. Let me know in the comments and I would be more than happy to do a part 2 on everything you need to know when buying a home. Thank you so much for tuning in and I will see you next Monday. I will see you next Monday. Later, rich girls.